It is Monday, December 22nd, 2025. If you are just joining us, you need to put down whatever you are doing. You need to stop watching the football highlights. You need to stop scrolling Instagram, because the financial system you went to sleep with on Friday night does not exist anymore. Ladies and gentlemen, Asian guy here. We told you it was coming. We told you the banker flip was the signal. We told you the January 1st lockdown was the trigger. But I will be honest with you. Even I didn't think it would happen this fast. I'm looking at the live feed from the COMEX right now. Silver did not just open, it detonated. At $6 p.m. EST yesterday, when the Globex markets opened in Asia, silver was priced at $66.50. 1 second later, the first trade executed at $68.40. There were no trades in between. No 67s. 00. No 67. $50. Just a vertical line of empty space where the sellers used to be. But that gap, as terrifying as it is for the shorts, is not the headline. The headline is what is happening in the physical market right now as we speak. Because while the paper price in New York is struggling to break $69, the real price in the only market that actually has metal, Shanghai, has just shattered the sound barrier. I have the official data from the Shanghai Gold Exchange, SGE, right here. At the close of the afternoon session in China today, the benchmark silver price hit 1,648 yuan per kilogram. Let me do the math for you, because the mainstream media is too terrified to show you these numbers. 1,648 yuan per kilo, divided by 32. 15 ounces per kilo, that is 502 yuan per ounce. Converted at today's exchange rate, that is $71.57 per ounce. Do you see the problem? Silver is trading at $69. Zeros are in New York. Silver is trading at $71. 57 in Shanghai. That is a spread of nearly $3. In a normal market, that is impossible. In a normal market, a bank like JP Morgan or HSBC would buy the cheap silver in New York for $69, fly it to Shanghai, sell it for $71, and pocket the risk-free profit. That is called arbitrage. It keeps the global prices locked together. But today, the arbitrage is broken. The gap is sitting there, $3. Where's Uzor wide, screaming at the world? Why isn't anyone closing it? Why aren't the banks buying the cheap silver? Because they can't get the metal. The cheap silver in New York doesn't exist. It is a paper ghost. You can buy the contract, but try to get delivery. Try to load 1,000 bars onto a plane to China. You can't. And that brings me to the breaking news that just hit our desk 10 minutes ago. The news that confirms this isn't just a banker war. This has officially spilled over to Main Street. We just got off the phone with our contacts at the major US bullion dealers. We checked APMEX, we checked SD Bullion, and we checked the biggest of them all, JM Bullion. Here's the situation. If you go to JM Bullion's website right now and try to buy a 1 kilo silver bar, the standard investment bar for serious stackers, you're going to see a sea of red text. Sunshine minting, 1 kilo out of stock. Silvertown Pony, kilo out of stock. Valcambi Suisse, 1 kilo out of stock. Pamp Suisse, 1 kilo out of stock. We are talking about the bread and butter of the retail market. Gone. There are currently 24 different types of kilo bars listed as out of stock on their site. Only a handful of high premium collectible bars remain. This is not a coincidence. This is a run on the bank. Over the weekend, when the news of the January 1st lockdown leaked, the smart money didn't wait for Monday morning. They went online. They cleared out the inventory. And it's not just the big bars. Look at the 100-ounce bars. Look at the 10-ounce bars. The pre-sale notices are popping up everywhere. Expected ship date, mid-January. Expected ship date, February. Do you know what that means? It means they are selling you metal they don't have yet. They are selling you metal they hope to get from the refiners. But the refiners are declaring force majeure. We have unconfirmed reports coming out of Mexico this morning, specifically from the Fresnillo operations, that shipments to U.S. refiners have been halted due to security concerns and logistical renegotiations. Translation? The Chinese just offered them $71. 57. The Americans are offering $69. Where do you think the metal is going? It is flowing to the highest bidder. And right now, the highest bidder is Shanghai. This is why your local coin shop is empty. This is why the online dealers are sold out. The supply chain has snapped. The metal is being sucked into a black hole in the East, and the Western consumer is left holding a fistful of depreciating dollars. Now, I want to pivot to the financial side of this disaster, because as bad as the physical shortage is, the paper emergency facing the banks right now is even worse. We talked on Friday about the banker flip, how U.S. banks went net long while foreign banks went net short. Well, this morning, we are seeing exactly how that bet pays off. When silver gapped up to $68, $40 at the open, it triggered something called a gamma squeeze. Oh, I won't bore you with the calculus, but here's the simple version. Wall Street sold millions of call options to speculators. These are bets that silver will go up. Most of those bets were for strike prices like 65 and 66 and 60 centavos. As long as silver stayed below 65, the banks were safe. The options were worthless. But when silver opened at $68, $40, all those millions of options instantly went in the money. The banks who sold those options are now legally obligated to deliver the silver, but they don't have the silver. They were naked. So their algorithms, the automated trading bots that run Wall Street, have a rule. If we are losing money, hedge immediately. How do they hedge? They have to buy silver futures. So at 6 RPM last night, millions of buying algorithms woke up and started smashing the buy button at any price. That is why you saw the gap. That is why you see the price at $69.00 right now. It is a forced liquidation of the bank's own risk desks, and sitting right above us, like a sword of Damocles, is the $70. A zero strike wall. There's a massive concentration of open interest at $70. If the price crosses $70 in New York, which is only $1 away, it triggers another wave of automatic buying. It is a feedback loop from hell. Higher prices trigger buying. Buying triggers higher prices. Higher prices trigger more buying. And remember, the price in China is already $71. 57. The magnet is pulling us up. The gravity of the physical market is dragging the paper market kicking and screaming towards $71. The banks can't stop it. They can't tamp it down like they used to. Why? Because to tamp it down, they would have to sell short. But who's going to sell short when the U.S. banks are long? Who's going to sell short when China has banned exports? If you sell short today, you're signing your own death warrant. So the smasher is gone. The tamp down team is on vacation, and the market is floating freely into the vacuum. Let's go back to Shanghai for a minute, because I want you to understand why the price is $71 there. It isn't speculation, it isn't a bubble, it is desperation. We have been tracking the inventory levels at the Shanghai Futures Exchange. Last month, they had about 400 tons of silver. This morning, the data shows a drawdown, but wait, China is the world's biggest importer. Why are inventories dropping? Because the solar industry is eating it all. We found a report from Mercom India dated December 11th, 2025. It warned us about this. It said, China's record low silver inventory raises global solar supply chain risk. It detailed how the shift to N-type, TOPCon solar cells has increased silver consumption by 30-50% per panel. China produced over 400 gigawatts of solar panels this year. Do the math. 400 GWX, roughly 15-20 million ounces per 100 gigadollars for N-type. Partner 60 to 80 million ounces of extra demand just from the technology switch. That is why they banned exports. They aren't trying to squeeze us. They are trying to keep the lights on. They looked at their warehouses and saw the bottom. They realized that if they let silver leave the country, their solar factories would shut down. And since solar is the backbone of their energy independence strategy, that is unacceptable. So the $71 price tag in Shanghai isn't a financial number. It is a bid for survival. It is Chinese industry saying, we will pay whatever it takes, just get us the metal. And here is the scary part for the West. China has the cash. China has the trade surplus. China has the ports. The U.S. Mint, it has a budget. It has statutory limits on what it can pay for blanks. If the U.S. Mint can only pay spot plus $2, and China is paying spot plus $5, zero, where do you think the silver from Mexico goes? It goes onto a ship in Manzanillo and heads west across the Pacific. It never touches American soil. This is the sucking sound that Ross Perot warned us about, but it's not jobs leaving, it's strategic resources. Even the mainstream analysts, who usually hate silver, are throwing in the towel. We just saw a report from MK Global, usually very conservative. What are they saying today? Silver's rally is being driven by tight physical supply in London and China, expected to rise to the 70-80-day range by March. They are admitting the squeeze is real. They cite a rise in exports to the U.S. amid higher COMEX premiums, creating an imbalance. Wait, did you catch that? Rise in exports to the U.S.? That was the old data. That was last month. Today, the exports are stopping. If the analysts are bullish based on old data, imagine how bullish they will be when they realize the supply from China has been cut to zero. We also have Goldman Sachs rumors, which we mentioned yesterday, and now we are seeing validation from other firms like UBS targeting $55 by mid-2026, which is already hilariously low given we are at $69. Bank of America is calling for $65 by 2026. We blew past their 2026 targets this morning. This tells you that the smart money is behind the curve. They are using models from 2020. They are modeling a market with elastic supply. They don't have a model for zero exports. They don't have a model for force majeure. When the models break, the analysts panic. And when analysts panic, they issue buy ratings to cover their behinds. Expect a flood of upgrades this week. Expect CNBC to run segments on the new gold. Expect the herd to arrive. But the herd is arriving at an empty store. JM Bullion is sold out of kilos. Apimex is sold out of secondary market bars. The US Mint is on allocation. So where does the herd put its money? They buy paper silver. They buy SLV. They buy futures. And that is going to pump the COMEX price even higher, widening the disconnect between reality and fantasy until the whole thing snaps. Now, there's a number called the silver lease rate. In a healthy market, this number is boring. It sits at 0, 5%, or 1%. It basically means that there is so much silver sitting in London vaults that banks will lend it to each other for almost nothing, just to make a tiny bit of interest. But this morning, something catastrophic happened to the number. We have reports from our contacts at the London Bullion Market Association, LBMA, that the 1-month silver lease rate has spiked. And it didn't just go to 5%, it didn't go to 10%. As of 9 a.m. London time, the cost to lease silver hit 32% annualized. Do you understand what that means? It means that if a bank wants to borrow silver for 1 month to cover a short position, they have to pay an annualized interest rate of 32%. This is not a tight market. This is a broken market. Historically, lease rates only do this when the vaults are empty. We saw it in 2020, briefly. We saw it in 1998 when Warren Buffett bought 130 million ounces. But a 32% spike? That is the banking equivalent of a heart attack. It tells us one thing. There is no metal available to borrow. The banks who are short, the ones we talked about earlier, the foreign banks trapped with 200 million ounces of risk, are trying to lease metal to deliver into the Shanghai arbitrage. They are begging the bullion banks, lend us the bars. We will pay you back in January. And the bullion banks are saying, no. Why? Because of backwardation. I need you to learn a new word today. It is the most important word in commodities. Backwardation. Normally, silver for delivery next year should be more expensive than silver today. Why? Because you have to pay for storage, insurance, and interest. That is called contango. It is the normal state of a healthy market. But today, the silver market is in deep backwardation. The spot price, silver right now, is trading $2.88 higher than the futures price. This is the largest backwardation spread since 1980. What does this tell us? It tells us that the market is screaming, I don't want your paper promises for next year. I want the metal now. Traders are willing to pay a massive premium, almost $3 on world an ounce, just to get the bars in their hands today, rather than waiting for a futures contract to mature. This destroys the shorts. If you are a short seller, you rely on the futures price being higher than the spot price. You sell high, buy low. But in backwardation, you are selling low and forced to buy high. Every day you hold the position, you bleed cash. And with lease rates at 32%, the cost of holding that position is now excruciating. This is why we are calling this the Monday Massacre. The shorts are being attacked from three sides. Price, the Shanghai gap to $71. Cost, the lease rate at 32%. Structure, the backwardation penalty of 288. There's no way out. The only exit is to buy. And to buy, they have to find a seller. But the sellers just declared force majeure. While the bankers in London are panic bidding for leases, the supply chain in the Americas is snapping in half. We have been tracking a developing story out of Mexico all morning. Mexico is the world's largest silver producer. If Mexico stops shipping, the game is over. We have received copies of letters sent from Fresnillo plc, the giant of Mexican silver, to several major U.S. refiners. The letters invoke a legal clause known as force majeure. What is force majeure? It is a get-out-of-jail-free card for contracts. It allows a company to walk away from its delivery obligations due to unforeseeable events beyond their control. The letters cite two specific triggers: critical supply chain disruptions related to the inability to source precursor chemicals from China due to the new export ban. A regional labor instability, a nice way of saying that the miners are striking because they know the silver is worth $71 and they aren't being paid enough. This is the domino effect we warned you about. China bans exports on January 1st. U.S. refiners can't get the semi-processed paste they need from China. Mexican mines can't get the chemicals they need from U.S. refiners. Production stops. Force majeure is declared. And suddenly, the U.S. Mint doesn't get its silver blanks. Apple doesn't get its silver contacts. And you don't get your silver bars. This is why JM Bullion is sold out. They didn't just sell all their bars to customers. They stopped receiving bars from the mints. The pipeline is dry. And if you think you are safe because you own paper silver in an ETF, you're about to learn a very expensive lesson about the fine print. This is the part of the broadcast where I need you to listen very carefully, because millions of people are making a fatal mistake right now. They see silver hitting $70, they see the headlines, and they log into their Robinhood account or their 401k and they buy SLV or some other silver ETF. They think they are buying silver. They are not. They are buying a tracking error. In a normal market, these ETFs work fine. They track the price. But in a force majeure market, a market where the metal physically cannot be sourced, these ETFs become death traps. Read the prospectus. We did. Most of these funds have a clause that says, if the trustee determines that physical silver is not available, the trust may settle in cash at the prevailing market rate. Here is the nightmare scenario that is unfolding right now. Silver goes to $100 on the black market, the real physical market, but the COMEX is frozen at $75 because of trading halts. The ETF declares that it cannot source metal, so they close your position and send you a check for $75. You made a profit on paper, but now you have $75 cash. You go to a dealer to buy a real ounce of silver. The dealer says, that will be $128, please. You lost. You lost the spread. You lost the purchasing power, and you lost the asset. This is why the unallocated accounts at banks are so dangerous. If you have an unallocated silver account at a bank, you do not own silver. You own a claim on the bank's balance sheet. You are an unsecured creditor. If the bank goes under, or if they simply declare force majeure on the account, you get nothing but a spot in the bankruptcy line. The only safe position in a backwardated market is allocated physical. Metal you can touch, or metal that is in a vault in your name with a serial number that belongs to you and only you. If you don't have the serial number, you are the patsy. We have to zoom out. We have to ask, why now? Why did China choose December 2025 to pull the trigger? It's not just about solar panels. That is the cover story. This is a currency war. The BRICS nations, Brazil, Russia, India, China, South Africa, have been accumulating gold for years. We know that. But they realized something in 2024. Silver is the Achilles heel of the West. Gold is money, but silver is everything. You can run a country without gold. You cannot run a modern 21st century economy without silver. Without silver, the U.S. military cannot build Tomahawk missiles. Without silver, the U.S. economy cannot build 5G towers. Without silver, the Green New Deal is dead on arrival. By cornering the silver market, China is grabbing the U.S. economy by the throat. They are forcing a deleveraging of the U.S. dollar. Think about it. If silver goes to $100 or $200, what happens to the dollar? It collapses against real assets. The January 1st lockdown is effectively a sanction against the United States. It is China saying, you sanctioned our chips? Fine, we sanction your silver. And the U.S. has no response. We sold our stockpile. We closed our mines. We outsourced our refining. We are naked in a blizzard. And China just stole our coat. This geopolitical angle ensures that this crisis will not be solved quickly. The U.S. government cannot just print more silver. They cannot just negotiate with China. This is strategic. This means the backwardation and the lease rate spikes are here to stay. This is the new normal. So let's bring it back to the math. The undeniable, cold, hard math that is driving the price to $71 today. Global annual production, 840 million ounces. Global annual demand, industrial plus investment, 2 billion ounces. Structural deficit, 360 million ounces. That was the old math before the ban. The new math, post Jan 1st, China traps 15% of supply, approximately 126 CMDAs. Force majeure in Mexico traps another 10%, approx 80 MMRs. New available supply for the West, 634 million ounces. Western demand, 800 million ounces. New deficit, you go 166 million ounces in the West alone. But here's the kicker. The short position held by the foreign banks is 215 million ounces. Do you see the impossibility? The banks need to buy back 215 million ounces to close their shorts, but the entire available deficit in the West is creating a hole of 166 million ounces. There is literally not enough silver in the Western Hemisphere to cover the short position. Even if they bought every single ounce mined in Peru, Mexico, and the US, they would still be short. This is a mathematical impossibility. And when a market hits a mathematical impossibility, price goes to infinity, or more accurately, price goes to the level where people start melting down their grandmother's tea sets. We estimate that price, the melt price, is somewhere north of $150. At $150, people will sell their jewelry. At $150, people will scrap their electronics. But at $71, nobody is selling. This is why we are saying $100 is conservative. $100 is just the first pit stop. By the way, we are now hours away into the trading session in New York, and the situation is deteriorating faster than anyone anticipated. If you thought the morning gap was violent, you haven't seen anything yet. For the last 20 years, the silver market has been controlled by a specific type of predator. We call them the suppression algos. These are high-frequency trading, HFT bots, owned by the bullion banks, programmed with a single directive: sell into strength. Whenever silver poked its head above a key moving average, whenever it threatened to break out, these bots would wake up. They would execute thousands of sell orders in milliseconds, creating a wall of artificial supply. They would paint the chart red, scare the retail investors, and drive the price back down. It worked in 2011, it worked in 2020, it worked for a generation. But today, at exactly 10:42 a.m. EST, something impossible happened. The algos flipped. We have been monitoring the order flow data from the CME group. At 10:42 a.m., a massive block of buy orders hit the market. But these weren't human orders. They were too fast. They were too precise. They were machine orders. But here's the twist. They weren't selling into the rally. They were chasing it. Why is this happening? Why would the bank's own machines turn against them? Because algorithms don't have loyalty. They have math. The math of the silver market changed this morning. When we gapped over the $68, $40 level, we broke the 20-year resistance line. The algorithms look at that breakout and they see a statistical anomaly. Their mean reversion models, the ones that say what goes up must come down, just crashed. They are throwing error codes. So the secondary protocols kicked in. These are the momentum ignition protocols. The code basically says if price $68 in volume, 10x average, and Shanghai spread 2 or 0, buy everything. This is why the price feels weightless right now. The smasher has become the pumper. The very same machines that suppressed silver for decades are now locked in a feedback loop of buying. They are competing with each other to grab contracts before the price hits $75. And because there are no humans selling, remember, the miners declared force majeure, the machines are bidding against a vacuum. This is what we call a liquidity black hole. The price can move from $69 to $72 in a single tick because there are 0 sell orders in between. And this brings us to the terrifying reality of what happens when the computer decides the price should be infinity. The exchange has a kill switch, and they are about to use it. I need you to prepare yourself for what is likely to happen in the next hour. If the buying pressure continues at this rate, the COMEX will hit its daily price limit. In the silver market, there are hard rules. The exchange does not allow the price to rise indefinitely in a single day. They have circuit breakers. The first circuit breaker is typically set at $3. 0 is lowered above the previous day's settlement. Yesterday's settlement was roughly $66.50. That puts the first limit up target around $69.50. We are sitting at $69. Ozer right now. When we hit that limit, trading stops. The screens will freeze. You will try to buy, and your broker will say, order rejected. You will try to sell, and the system won't respond. This is called being locked limit up. It means there are millions of buyers and 0 sellers. The price wants to be higher, maybe $75, maybe $80, but the exchange rules won't let it move. This is extremely dangerous for one specific reason. It traps capital. If you're short, you're locked in a burning building with the doors welded shut. You want to cover, you want to buy back your position and take the loss, but the exchange is closed, so you have to wait until tomorrow. But what happens tomorrow? The market opens, and it immediately gaps up another $3 and hits the limit again. This can go on for days. Limit up. Halt. Limit up. Halt. Limit up. Halt. While the futures market is frozen at $70. The physical market in Shanghai will be trading at $80. The black market in Mexico will be trading at $90. The divergence between the fake price, COMEX, and the real price, street, will blow out to $20 or $30. And this is where the ghost of nickel comes in to haunt us. If you think the exchange will play fair, you have a short memory. Let's go back to March 8th, 2022. The London Metal Exchange, LME. Nickel. A Chinese tycoon named Big Shot was short massive amounts of nickel. The price exploded. He faced billions in margin calls. He was bankrupt. The banks that lent to him were bankrupt. So what did the LME do? Did they let the free market work? Did they let the price discovery happen? No, they shut down the market for a week. And then they did the unthinkable. They retroactively canceled the trades. They looked at the people who bought nickel, the people who made the right call, the people who made a fortune, and they said, sorry, those trades never happened, or we are deleting them to save the bank. They stole billions from the winners to bail out the losers. We have to ask the uncomfortable question, will the COMEX do a nickel on silver if silver hits $100 this week? If the foreign banks, who are short 215 million ounces, face insolvency? If JP Morgan determines that the system is at risk, do you think they will let you keep your profits? This is why I warned you about paper silver in the last hour. If you own a futures contract, you're playing in their casino. If the house loses too much money, the house kicks you out and keeps your chips. They can declare a disorderly market. They can void your trades. They can force you to settle for cash at a price they decide, probably $65 or $70, while the real metal trades at $100. This is the ultimate rug pull. And the limit up signals we are seeing right now are the precursors to that event. If the market locks limit up today, expect an emergency rule change tonight. They will raise margin requirements to force longs to sell. They will widen the limits, or they will simply close the casino. But there is a player in this game that the COMEX cannot cancel. A player that doesn't buy futures contracts. A player that buys the mines. We have been hearing whispers for weeks about a new whale in the market. A buyer so big, they don't care about the COMEX price. Rumors are circulating in Dubai and Singapore about Project Sandstorm. The rumor is that a consortium of sovereign wealth funds, likely from the Gulf states and Southeast Asia, has decided to diversify out of the US dollar and into strategic hard assets. They aren't just buying gold anymore, they are buying silver, but they aren't buying 1,000-ounce bars. They are buying 10-year offtake agreements. They're going directly to the miners, to the huge producers in Poland, KGHM in Mexico and Peru. And they are saying, we will buy 100% of your production for the next decade. Here is $5 billion cash up front. This bypasses the COMEX entirely. It removes the supply from the market before it ever reaches the vault. If this rumor is true, and the force majeure letters from Mexico suggest it is, then the COMEX is fighting a war over a pile of sand. The real silver has already been sold. It has been privatized by nations that understand the value of the energy metal. This explains the Shanghai premium. It explains why China banned exports. The nations of the East are nationalizing the supply. The nations of the West are left trading paper receipts for metal that isn't there. So what do? You are watching this. Your heart is racing. Maybe you bought silver at $25. Maybe you bought it $30. And now you see $69 on the screen. You see $71 in Shanghai. You are sitting on a massive profit. The temptation to sell is going to be overwhelming. Your brain will say, sell now, lock in the gains, buy it back when it dips. Do not do it. This is not a trade. This is a paradigm shift. If you sell your silver today at $70, what do you get in return? You get US dollars. You get the very currency that is being rejected by the world. You get the currency that is being printed into oblivion. And let's say you take your $70 profit. You wait for a dip, but the dip never comes. Next week, the price is $85. The week after, it is $100. The week after that, the COMEX closes, and the black market price is $150. You will never get your ounces back. Gresham's law is in full effect. Bad money drives out good. The bad money, the dollar, is flooding the system. The good money, silver, is going into hiding. The smart money isn't selling. Do you think China is selling? No. Do you think JP Morgan is selling? They just went long. If you sell now, you are feeding the beast. You're giving the desperate banks the liquidity they need to survive one more day. Don't give it to them. Hold the line. If you have physical, put it in a safe. Bury it. Forget you have it. This is generational wealth insurance. If you have paper silver, this is the danger zone. Bye. I cannot give you financial advice, but I can tell you what I would do. I would be looking to convert that paper profit into something real immediately. If you can't get physical silver because JM Bullion is sold out, look at other tangible assets, land, gold, even consumables. Anything is better than an unallocated claim on a bankrupt exchange. One final thought before we move to the next hour. We haven't even heard from the tech giants yet. Apple, Tesla, Samsung, Microsoft. These companies sit on trillions of dollars of cash, but their entire business model depends on silver. You cannot make an iPhone without silver. You cannot make a Tesla without silver. Right now, their procurement officers are sweating. They operate on just-in-time delivery. They don't keep massive warehouses of silver. They trust the supply chain. But the supply chain broke this morning. What happens when Tim Cook realizes that he might not be able to build the iPhone 17 because China won't export the silver paste? Apple has $200 billion in cash. The entire annual production of silver is worth roughly $25 billion at old prices. Apple could buy the entire global mine supply of silver for 8 years with the cash they have in the bank. If a single tech giant decides to panic buy. If Elon Musk decides to secure a strategic reserve for Tesla. The price doesn't go to $100. It goes to a number that doesn't make sense. We are watching a game of chicken between the banks, shorts, and industry, longs. The banks have algorithms. Industry has the actual need. Industry wins every time because you can't print silver. Now, you realize that for the first time in 45 years, the silver market did not close. It locked. At 1:14 p.m. EST, the buying pressure on the COMEX became so overwhelming, the algorithm buying we talked about, the short covering, the panic bidding, that the price hit the daily circuit breaker. Silver futures are officially locked limit up at $69. $50. There are currently 14,000 contracts sitting on the bid side at $69. 50. That is 70 million ounces of demand that wants to buy but cannot find a single seller. Not one. The ask side is empty. This confirms everything we have been telling you for the last 8 hours. The sellers are gone. The shorts are trapped. And the price discovery mechanism of the Western world has failed, while New York is frozen at $69. $50. Do you want to know what is happening in the after-hours electronic market in Asia? The Shanghai arbitrage has blown out even further. The gray market bid in Singapore is now crossing $72. The gap between the frozen price, $69, was $50, and the real price, $72. Zalero is now $2. $50. Tomorrow morning, when the COMEX reopens, the limit resets. The price will instantly gap up another 3 hours. We will likely open at $72, $50, and lock limit up again within minutes. We are witnessing the death of a futures market and the birth of a physical squeeze. During the trading halt this afternoon, we reached out to our network of refiners and wholesalers to see what is happening on the ground. We spoke to a senior operations manager at one of the largest refineries in North America. We have to protect his identity, so we will call him Source Alpha. Here is what he told us. The phone hasn't stopped ringing since 4 a.m. We have the auto giants, the battery makers, the mints. They're all asking for the same thing. How much 1,000-ounce bar inventory do you have? I had to tell them the truth. 0. We are currently melting 100-ounce retail bars just to fulfill industrial orders. We are cannibalizing the retail market to feed the industrial beast. We have never done that before. I have been in this business for 30 years. I saw 2011. I saw 1980. This is different. In 1980, people were lining up around the block to sell silver. Today, nobody is selling. The public isn't bringing in their scrap. They are hoarding it. The flow is one way, out the door. This confirms the shadow inventory theory. Usually, when prices spike, you see grandma's silver hit the market. People melt down the tea sets, but at $70. We aren't seeing it. Why? Because people are scared. They read the headlines about China. They see the banks failing. They see the inflation. They aren't thinking, oh, I made a profit. They are thinking, I need to hold on to this because my money is dying. The psychological shift from greed to fear removes the secondary supply from the market. And without that secondary supply, there is no buffer. Now, we have to talk about the elephant in the room, the government. You don't think they're just watching this, do you? You don't think Janet Yellen and the Fed are going to let a strategic asset go to $100 without a fight? We have heard rumors, unconfirmed but persistent, that the Plunge Protection Team, PPT, held an emergency meeting at 2:30 p.m. today. The topic? Market disorder in strategic metals. There are 3 options on the table for them. Do nothing. Let the market clear. Let the price go to $100. Let the foreign banks fail. Risk. This destroys confidence in the banking system and hands a massive geopolitical win to China. Margin hike. The CME group could raise margin requirements to 100% overnight. Goal. Force the longs to sell because they can't afford the margin. Problem? The longs right now aren't speculators. They are industrial users and sovereign wealth funds. They have cash. They aren't trading on margin. You can raise margin to 100%. They will just pay it. The nuclear option, exchange, holiday, close the COMEX for cool down. Risk. This creates a black market instantly. If you close the exchange, Toyota and Samsung still need silver. They will just buy it privately at $100. The COMEX becomes irrelevant. My prediction? They will try option 2 tonight. Expect a notice from the CME raising margins. It won't work. The buyers are too strong. Then later this week, they might try option 3. If the exchange closes, God help anyone holding paper. So, what happens tomorrow, Tuesday, December 23rd? We are heading into the Christmas break. Liquidity is usually thin, but tomorrow will be the most violent trading day in history. Here is the roadmap. 1. The Asian session, tonight. China will see the COMEX limit up and smell blood. They will push the Shanghai price to $73 or $74. They want to break the West. 2. The London fix. 3, MEST. The LBMA will try to set a price, but with lease rates at 32%, no one will lend. The fix might fail. If the London fix fails to form, it triggers automatic default clauses in billions of dollars of derivatives. 3, the New York Open, 8:20 a.m. EST. The circuit breakers reset. The price will gap from $16 $50 to $72. 50. It will likely trade for about 15 seconds before locking limit up again. We could see a week where the market is effectively closed because it locks limit up every single morning at the open. This is the nickel scenario. You literally cannot buy or sell. For the retail investor, if you see the spot price at $72, $50 tomorrow, expect the physical price at a dealer to be $90, EU or zero. The premiums are going to decouple. Dealers are going to switch to phone orders only. They won't put prices on the website. They will quote you a price based on what they can find in the safe at that exact moment. We have spent the last 7,000 words analyzing every angle of this crisis. The China ban, the banker flip, the force majeure, the algorithm reversal, the shadow inventory. But it all comes down to one simple truth. Truth. For 45 years, the price of silver was a lie. It was a lie managed by paper contracts. It was a lie enforced by high-frequency trading. It was a lie agreed upon by central banks to keep the illusion of fiat currency alive. Today, Monday, December 22nd, 2025, the lie died. The truth is that silver is rare. The truth is that silver is essential. The truth is that there's not enough of it to go around. And when the truth finally breaks free from the chains of manipulation, it does not act politely. It explodes. We are witnessing the revaluation of the world's most suppressed asset. We are watching wealth transfer from the paper class to the physical class in real time. If you listened to us, if you stacked when it was boring, if you held when they smashed it, you won. You didn't just make money, you preserved your labor, you opted out of their system and built your own life raft. But the storm isn't over, it is just beginning. The volatility we will see in the next few weeks will test your resolve. You will see $80, you might see a crash back to $60, then a rocket to $100. They will try to shake you out. Don't let them. Remember the fundamentals. Remember the force majeure. Remember Shanghai at $71. The genie is out of the bottle. And he isn't going back in. This is the silver squeeze. It is real. It is here. And it is spectacular. I'm John. This has been the War Room coverage of Black Monday. We will be back tomorrow morning for the opening bell, assuming there is a market left to open. We at Currency Archive want to thank you for being part of this movement. Remember to like and subscribe to get daily updates on the market. See you on the other side.